The Indian rupee woke up to a historic low today, slipping past the 90 mark against the US dollar for the first time ever. It's a symbolic level, one that signals more than just a number on a currency chart. Over the last few days, the fall has been steady. On Tuesday, the rupee closed at 89.95 versus the dollar, after losing 42 paise in a single session. And if you zoom out, the picture becomes clearer. The rupee has already fallen around 5% this year. In fact, it's now one of the worst performing currencies in Asia. But here's the twist. This decline isn't happening because of India's weak economy. Quite the opposite. India's GDP growth has been stronger than expected. The real pressure is coming from outside. Higher US tariffs on Indian goods, delays in a key trade deal with Washington, and foreign investors pulling money out of Indian markets. Foreign investors have withdrawn nearly $17 billion from Indian stocks this year. Foreign direct investment has also been muted. When money moves out, demand for dollars rises, bringing the rupee under further strain. Add to this a widening trade deficit, which crossed $40 billion in October, and a need for the dollar only grows. And that demand matters, because India depends on imports for essentials like fuel, electronics, cooking oil, and fertilizers. When the rupee weakens, these imports become costlier. A weaker rupee, simply put, is like having a smaller shopping budget when the prices abroad stay the same. Domestic markets have felt this pinch too. The Nifty slipped below the 26,000 mark. The Sensex lost nearly 200 points as a fall in currency raised concerns about inflation and foreign money exiting. But for most people, the real impact will be felt at home. Petrol and diesel may inch up in price. Gadgets could become more expensive. Students paying international fees will feel the jump immediately. Vacations abroad will cost more. Even home loans could eventually face pressure if inflation rises and interest rates shift. So why is the Reserve Bank of India, the country's central bank, not stepping in aggressively as it has earlier and during other currency crises? Because something has changed. The International Monetary Fund recently reclassified India's currency system from stabilized to cruel-like. That means the RBI is guiding the rupee's movement, not fighting every fall. Rather than drawing a hard line at 90 or any other level, the RBI now prefers gradual, controlled depreciation that reflects the country's trade realities and inflation gaps with the world. In simpler terms, the central bank is choosing patience over panic, and that's what makes this moment different. The dollar isn't unusually strong. India isn't short of reserves. The RBI isn't scrambling. Instead, the rupee's slide seems to be part of a long-term adjustment, a slow reshaping of India's piece in a shifting global economy.
We believe the dollar weakness next year should support mild rupee appreciation, and that could pick up pace around seasonally favorable first quarter for rupee.
For now, the currency is signaling that the world is changing, and India needs to adjust with it. The next few weeks will reveal if the rupee's fall is just a passing phase of the start of a new normal. For more on this, we have with us Professor Vikas Singh joining us live from New Delhi, India. Thank you for joining us.
Good evening, Joshua.
So after dropping below the 90 rupee barrier, where do you see the Indian currency in the longer term compared to the dollar, and why is that?
I think in the long run, I think we must not get panicky about the drop of 5% over the last 1 year or so. We must remember that our currency has not dropped as much as the other Asian countries. This has happened not because the weakening of the Indian economy, but more because, as you rightly said, the Federal Reserve is keeping the interest rates higher, which means that the global capital is moving back to the US Treasury market. This is not unique. Almost every Asian currency from the yen to the won has weakened sharply. On top of that, India's energy dependence makes the currency a little bit more sensitive, and we import more than 80% of our crude. When oil prices rises and the dollar is strong, I think the pain is more visible. However, I don't see this lasting. The Indian economy is very strong, and the Reserve Bank has every arsenal in its books to fight this if needed. Reserve Bank of India has, and rightly so, not panicked. hasn't doesn't have a number to fight the currency number. So it's not that if it goes over 90, it will step in. It's it will step in at the right time, and I think it's working in a very mature manner.
Yes, and Vikas, I'd like to expand on that if possible. You mentioned stepping in. What measures could be put in place if this does continue to drop? And we have mentioned, of course, it's outside of India's control, but could there be a response?
I don't think it will ever go beyond India's response, because I think if you look at the economy, the GDP growth rate is among the highest. India is a very strong economy. The economy is strong not only because of the internal and domestic consumption, but also because our balance of payment has never been as strong as it is today. The Reserve Bank of India believes that our forex reserves are comfortable. The RBI also has the credibility and the firepower to manage this volatility. The central bank will not defend a fixed number, as I said earlier, but it will prevent disorderly movement and excessive speculation. It hasn't come to that yet. India's current account deficit is under control. Our growth rate remains one of the highest globally, and investor confidence is pretty high. So I don't think the RBI needs to move in now or needs to panic and take uh, any decision that indicates that we are in trouble.
Yes, and Vikas, to finish, I want to look at the United States. How is the ongoing trade situation with the US impacting the rupee? And what could a potential trade deal with the Trump administration mean for the currency?
I mean, as I've been always saying that the trade deal is not a big deal for India, because India is not a great trader. Our economy is not dependent on the trade deal. But it's something that we need. It's something that signals that all is okay between India and the US. So that's the reason why the trade deal is important. It's not important for the economy per se, but what it signals is more important. Uh, I think the trade deal is in its final stages. If it doesn't happen this quarter, it's definitely going to happen in the first quarter of the next financial year, first quarter of the next calendar year. So
Okay.
that's not a worry. Uh, we must also remember that the US needs us as much as we need it, and I think the Indian negotiators have done well. They haven't panicked. They've acted in a very mature manner, and I think the deal is closer than we think.
Yes, Vikas Singh, thank you ever so much for your time and your insight.
Thank you so much. Have a great day.
They promised glory. They delivered fear. They shaped nations. They scarred generations. From brutal purges to propaganda machines, from stolen power to violent falls from the throne. Welcome to The Dictator, a series that strips away the myth and then exposes the men behind the tyranny. History remembers their power. Firstpost reveals their truth.